Good morning, everyone, and welcome to the Nedgroup Investments Global Quarterly Roundup. It was another interesting quarter where emerging markets outperformed the developed world. We also had so much unexpected news flow around tariffs, geopolitics, and central bank actions. So I'm very pleased to welcome my first guest for today, Alex Ralph. Alex, welcome, and how are you?
Thank you. Yeah, good. Thank you. You?
Brilliant. Thank you so much. So everyone, Alex is a portfolio manager at Palomar Fixed Income. They manage the Nedgroup Investments Global Strategic Bond Fund. So Alex, I do have a couple of questions here for you. Shall we get going?
Yes, please.
Okay, great. So Alex, the first one is just around performance, please. I mean, you and your co-portfolio manager, David, have done an amazing job with performance. I mean, clients must be very, very happy if you look at the degree of outperformance of the fund relative to various benchmarks. And despite so much volatility in markets and so many unexpected things happening that you've had to deal with, can you please talk us through that?
Yeah, absolutely. It has been a very good year to date and quarter. Q3 performance. We outperformed our global ag benchmark by 1% during the quarter. The themes really have continued from all year. Essentially, we've seen significant volatility in government bond markets, not just within duration, but also into geographies. So, for instance, this quarter we had a quite significant position in New Zealand bonds, for example, and they rallied significantly on the back of deteriorating economic data. US Treasuries this quarter rallied a little bit, but on the flip side, Japan and France yields rose quite a lot, and we had no exposure to France, which helped our performance. And also, after Japanese yields rose quite significantly, we actually bought the long end Japan for the first time in actually David's career, which is quite a long spanning career. So yeah, it was quite a moment for us on the desk in that point. But yeah, the performance did come from geographic calls on the rate side, but also yet again we saw very low volatility within credit spreads, and we benefited from our allocation to credit and had some decent stock selection over that time period as well. So the themes of the year continued in Q3, and we had all these small trades that benefited and added to that 1% outperformance.
Thanks, Alex. And I just noted on your slide where you mentioned about rotating into longer dated bonds in response to kind of changing curve dynamics. Can we dig into that a little bit more, please? I mean, how did things change over the quarter, and what did you observe across different markets?
Yes, so essentially the performance didn't just come from kind of cross geography opportunities, but the fact that the yield curve steepened. So the short end of the curve really outperformed, and the fund was very much positioned for that. So we had that benefit. But at some point towards the end of the quarter, we felt that steepening had occurred to an extent that we actually cut quite a lot of that and rotated some of that shorter dated bonds into longer dated bonds to take advantage of the value that we saw there. As you know, the fund is really a value driven process, and it really started to look like there were opportunities further along the curve. And so we cut, not completely, but we did cut our big overweight we had in steepeners.
Thanks, Alex. And I guess in terms of where you mentioned about rates market volatility creating opportunities to generate alpha, I mean, that sounded very interesting. Can we delve a bit more deep into that, please? And like, how did it play out, and where were the most compelling opportunities that you found?
Yeah, absolutely. So if we take a look at, for example, last year we had huge duration changes and yield curve duration changes within the US market. We had times where Fed cut rates were significant in the market, and sometimes where they'd been completely priced out. So the market was really swinging quite violently. This year hasn't swung to the same extent, but we have still seen trading range patterns occur, and that volatility still continue. In particular, for example, we've seen the UK from the start of the year really trade in a range that we've been able to go underweight and overweight at separate times, depending on how much was priced into the market. And that volatility, not just in the UK, but we have seen it in the US as well. And actually, currently at the moment, we see the US 10-year trading between 4 and 4.2, and we're really taken that opportunity to cut and add positions accordingly. So yeah, the volatility in rates has really been able to provide us that opportunity to add alpha. So it isn't just geographic dispersion or steepness, but also the volatility that been able to give us that extra ability to add.
Yes, brilliant. And Alex, also you mentioned about how credit spreads are quite low at the moment. What would you say are driving these credit spreads lower, and kind of what are you reading into this and what are you taking out of it?
Yeah, so I was asked recently if it was credit spreads at these levels were irrational exuberance. And actually, really, the answer to that is it's pretty rational. We've seen companies since interest rates go up actually maintain quite a defensive balance sheet. It's also, so really it's a fundamental factor. But on the high yield side as well, the index has become a lot more defensive as private credit, kind of the booming private credit has taken away a lot more of the riskier companies to the private side. So there is a fundamental justification for it. It's just that at these particular levels, there's no leeway priced in at all. There's no possibility of weakening of economic data, or we think the canary in the coal mine, which is private credit. We do think that that is a possibility of a tail risk event coming into private credit. So we do think the market is expensive, therefore we are positioned quite defensively. We have cut towards the end of Q3, we did cut some of our higher beta positions, and now we've actually got the lowest corporate hybrid position we've had on since we launched the fund. So we do think at this point in the valuation it is prudent to be more defensive.
Thank you. And you have kind of started talking about already about fund positioning. We'll get into that in a moment. I just wanted to just pause for a second and just ask you to please kind of give us your outlook for Q4, as well as summarize some of the discussion that we've had already, kind of pull out the key points for our listeners, please.
Yeah, absolutely. So Q4 we think is going to be very much the same in terms of government rate markets. That volatility we think will continue. We think there'll be further geographic dispersion, and we do think we will be able to add alpha by moving the duration to reflect how much the market has got ahead of itself in either direction. So we do think we'll be able to add alpha there as well. We do think Q4 we could see actual volatility in credit spreads return. We saw First Brands, which was a auto loan company in the US, do quite a surprising default in recently, which has caused a bit of volatility within higher beta credits in the public markets. We think that could continue and may provide an opportunity for us to change the credit beta on the portfolio. So we're really looking out for that. As I said, currently we are defensively positioned, but volatility might give us an opportunity to pick up some cheaper credit assets. So we're hopeful that that could come around in Q4. So we're looking for that credit volatility, but also maintain opportunities within the rates market and take advantage of that.
Great. And perhaps just pulling all of this together, because there really is so much going on. So my last question for today to you, please, is just around the actual fund positioning. So how is the fund positioned to kind of navigate all of these conditions, and how are you looking to, let's say, take advantage of opportunities to generate alpha?
Absolutely. So at the moment, we are slightly underweight US duration. That's purely because the market has rallied quite significantly and already priced in quite a few rate cuts that we do expect, but it's just a temporary underweight position. We have a small position in Japan, but it's still underweight because we do think there will be further volatility in yield increases, particularly in the short end of the Japanese market. We still do have an overweight in New Zealand and think that in the long end now, because we do think that the curve will flatten there, having steepened so significantly. And within credit, we are quite defensive. As I mentioned, we have around 64% in credit, but our corporate hybrid and higher beta financials position is only 8% now, having been cut from around 13%. So we do have room to add there. We've still got an overweight within European credit because we do think the valuations are more attractive in Europe relative to the fundamentals. We're slightly concerned on US credit fundamentals in terms of the consumer. So we're positioned still very much within Europe. There might become an opportunity where we change that if US spreads start to reflect the possible US consumer risks, but that hasn't actually materialized yet. So that is a possibility into the coming quarter.
Alex, thank you so much. It was a pleasure having you join us, and we look forward to keeping in touch.
Great. Take care.